Hi, Greg Weldon here, and welcome to a special edition of Weldon Live for our YouTube channel followers. And we asked the question, Jerome Powell Con Man? Before I get to that, I do want to throw up the email, but more importantly, I will disclose all of our positions as if this was a regular Weldon Live at the end of this video. You want the full 58-page report, email me now. Breaks down the Fed, all the economic data from this past week, and the markets, where they've been, where they're going, and what we expect to do about it. In terms of con man, Jerome Powell's not a con man, all right? In fact, quite the opposite. Jerome Powell has talked the talk and then walked the walk. He has told us what he thinks, then he has told us what he's going to do, and then he goes out and he does it. But the confidence angle comes in terms of the confidence the Fed is not showing us as it relates to policy, inflation, the economy, so on and so forth. They want to be confident that inflation will not only is backing down, but will stay down. It will come down, and they can declare victory at some point in time. The FOMC may not raise their policy rate again. Absolutely may not. But there's evidence to suggest that inflation may be returning. We have the base effect in energy that kicks in, particularly when you look at something like natural gas in January and February. All right. And when you talk about the ISM numbers, I mean, we see a push higher in prices, not only expected down the line, but right now happening, particularly in food and energy. All right. The recession is wafting through the economic data. I mean, it's there. All right. And let's not forget, we have only had a restrictive Fed policy for only 5 months. You got to go back to May, 5, 6, 7, maybe 7 months. At the outside, 7 months. Your timeline cannot begin when the Fed started raising rates because they were so far behind the curve, and rates, the real policy rate was so deeply negative, it was actually stimulative. So no wonder the economy hasn't rolled over yet, but it's coming. The data is absolutely telling us this. The question then becomes, what if inflation goes back higher and reaccelerates, which I think is going to happen? Then the real question for the Fed will be, what's more important, protecting the economy or fighting inflation? If the economy is strong, there won't be an argument. It'll be tighter policy. And Powell just told us this. This was not necessarily a dovish press conference. Let's look at the exact words. All right? We're committed to keeping policy restrictive until we are confident inflation is on path to our objective. In other words, we're not confident, and they're not even confident about inflation, but actually it goes beyond that and before that, because they're not even confident that policy is sufficiently restrictive. That's really interesting. I mean, we're committed to achieving a stance that's sufficiently restrictive, but we're not yet confident we have achieved such a monetary stance. Bam! Not confident we're sufficiently restrictive. Saying this in multiple different ways. So then the question comes, and look at Powell, because it's like, you got to be kidding me, dude. How many times I got to tell you the same thing over and over? You ask the same question. You expect me to couch my answer for you versus what I just said? You're trying to trip me up? Is this like a cross-examination? You know, you seem to imply you're not yet confident that policy is restrictive enough to finish the fight. Is that true? And Powell's only response, 4 words. Yes, that's exactly right. Hello, you dumbass. Not confident. Financial conditions are restrictive enough. Not restrictive enough. You know, we're not even talking about how long they need to be restrictive for yet. We're not even talking, we're talking about getting policy restrictive enough that then we can leave it there. All right? Tighter financial conditions from bond yields rising and the dollar have, could matter for future rate decisions. Now, this is a double-sided machete, because he could be talking about, well, dollar goes higher, bond yields go higher, so the market does the dirty work for us, and if we see the tightening from the markets, that will matter for future rate decisions. We may not have to hike rates because the market will do it for us. Or are they basically saying, well, we'll let the market take the lead here, and if the market believes inflation's coming down and it's going to be okay, and the economy might actually be as bad as the most recent batch of data tells us it is, then they can take the dollar lower and they can take bond prices higher, bond yields lower. And that's exactly what's happening. All right? But he's saying tighter conditions need to be persistent, and it remains to be seen. We're seeing fluctuations back and forth in inflation. We're not looking for that. They want inflation pegged at 2 to stay at 2, and they're nowhere near that. They really aren't. Tighter conditions need to be persistent, and the persistence needs to show up in the data. That is not happening. Not even close in terms of inflation. It's going to go back up. It's a question of by how much, because the base effect in energy and a lot of food prices have bottomed. You have El Nino, and you have the Panama Canal, and you have a whole bunch of other stuff that is still in play. Hasn't gone anywhere. Here's an interesting comment. It's only the beginning. In other words, if we have to tighten, we've only tightened this much by his fingers versus his arms wide open, all right, arm length to arm length, fingertip to fingertip with your arms spread wide is how much. All right. Now, that's a dramatization, but I just love this picture. It's only the beginning of what it will take to build confidence. We have a long way to go. He did say we're almost done, too, so his comments are polarized. But if you listen to the totality of his comments, they are not dovish. And he can't be dovish yet because the stock market's near new highs. Gold's pressing 2,000. The economy has not fully rolled over yet to where enough people acknowledge that you have a contraction going on. It's only the beginning of what it takes to generate confidence. Now, when asked if the recession was back on the staff's forecast as a baseline going forward, he says yes, but only if monetary conditions remain tight. And we don't know how persistent this will be. I mean, it's too early. The main reason we don't know how persistent this will be. I mean, that's really interesting. If you think about it, no recession. We need to be more persistent until we achieve the goal of a recession because, frankly, that's the goal. All right? Now, they want to avert a deep recession, and they say they want, a period of economic growth below trend. Well, right now, the trend is barely positive, so you'd have to be in a recession to be below trend. We are attentive to the data about the resilience of economic growth. Okay, well, he wasn't looking at the most recent data. He was not looking at the Dallas Fed, manufacturing, retail, or service sector surveys, which I cover in this report, not today here in this video, and the ISM data. These were terrible data points. The labor market data was horrendous. Horrendous. You're talking about wanting to see some softening in the labor market. You just like it was Mr. Bill getting hit by Mr. Hand with a hammer. That's how soft this labor market data was. All right, it wasn't negative, it wasn't contraction, but it kind of was. We're attentive to that. Evidence of growth persistently above potential could warrant further tightening. In other words, if we don't squash the economy, we'll continue to tighten further. He can't be any more plain. He's not a confidence guy. This guy talks the talk and walks the walk. He's told us everything he's going to do since 2018. Let inflation go above target. No tolerance bands, which are really intolerance bands. All right, that they would let it stay there for a period of time, potentially as long as 8 years. They wanted average inflation up over an 8-year period. And then that they could fight that using the Volcker playbook. He's done exactly what he laid out in 2018. He's the most forward, and transparent Fed governor we've ever had, or Fed, chair we've ever had. And here you go. Last question. Would you say the bias is neutral and there's no disposition to hike again? How many times do I have to tell you people in the press what I'm saying? You can keep asking me the same question, think I'm going to change my words. No, I wouldn't say that at all. Okay? No. How clear can I be? The Fed's bias maintains a disposition, quote unquote, tilted towards tightening. That's simple. Now, the markets disagree. All right? The markets are going to do what they want to do because they want this, come on. The vested interest on behalf of most market participants is to see stocks go higher. So, of course, they wanted to rally this. I said in my WeldonLIVE on Wednesday, they want to rally this market before the Fed and Tuesday and Wednesday morning. I said the market wants to rally. It feels like it wants to rally. And they got the excuse to do it. You've hit some retracement points, but this is a big deal going forward because the dollar got whacked. And that's big. That is huge differential. Bond yields are kind of breaking out. I like the short end better, but there's not a lot of alpha in the short end, so that's a problem. We do every day in the live. We give the picks. There they are. There's our positions. If you want a copy of the 58-page report, you want to check out the WeldonLIVE, email me, sales@weldononline.com. Thanks for listening.